Good evening. I am very pleased with our performance this quarter. As you are aware, in quarter 2, we saw significant changes in our management and board. Despite that, we reacted very fast, proactively reached out to all the stakeholders and assured them on continuity and stability. We are very encouraged with the feedback we have received from all the stakeholders, including our clients and employees. With this backdrop, our performance this quarter has been very good. Our revenues grew 2.9% on reported basis and 2.2% on constant currencies. Our margin was steady at 24.2%. Revenue per employee increased to $52,700, 7th consecutive quarter of increase. Our utilization improved to an all-time high of 84.7%. Utilization excluding trainees also increased to 81.7%, which once again is an all-time high. Our volumes grew by 1.6%. Since last quarter, we started reporting revenues from new services. Very pleased to say the revenues from new services grew significantly ahead of company growth. It grew on a quarter-on-quarter basis by over 14%. Today, revenue from new services constitutes about 9.4% as compared to 8.3% in the previous quarter. Together with software, today 11% of our revenue comes from new services and more than 50% of our incremental revenue this quarter come from new services and software. We have also see continued adoption of our software platforms like NIA, where we have had over 200 implementations across 100 clients in the last few quarters. Net, we see good progress. We have also seen good progress on large deal wins. We won 5 large deal wins, total TCV of $731 million, with net new of $495 million, which again is one of the highest in the last few quarters. While the team has been focusing relentlessly on execution, the management team, along with the board of directors, also undertook a comprehensive review of our strategy. We looked at all the strategic elements. We looked at what is working, what is not working. We prioritized areas where we need to invest, and we came up with accelerated plans. One of the outcomes of this exercise was our reinforcement that our current strategy is relevant, continues to be relevant, and we just need to accelerate the execution. So our strategic differentiation will continue to be driven by design, consulting, and technology services enabled by software. Coming to the guidance, given our performance in H1 and the typical softness we see in H2, we have revised our revenue guidance to 5.5% to 6.5% in constant currency. Net, it's been a very good quarter all around, and we are continue to be very optimistic and confident about the future. Thank you. I will now pass on Ranga to say a few words.
Thanks a lot, Praveen. Q2 has been a quarter of stability and quarter of performance, overall performance. I think if you look at the customer relationships have been stable, as evidenced by the increase in the large deal wins that Praveen mentioned. Our large deal win trajectory continued to improve during the quarter, crossing $700 million. At the same time, our relentless focus on operational efficiency for the last several quarters continued into this quarter. I think you all know about the highest utilization. I need not repeat again about it. Of course, the on-site mix came down again this quarter by 0.7%, which also helped us. Likewise, the employee cost as a percentage of revenue, subcon as a percentage of revenue, and as well as the on-site employee cost as percentage of revenue. Several operating parameters improved during the quarter. All this led to a stability in operating margins. We are at 24.2. You would recall that our annual guidance for operating margins is 23 to 25%. If you look at the first half of the year, we are at 24.1, essentially at the midpoint at this stage. Now, coupled with that, we had a very healthy net margin improvement during the quarter. It was 21.2 for this quarter as compared to 20.8 last quarter. More than anything else, if you look at the H1, we had a very robust cash generations. Our free cash flow increased by 19% year on year on a half year to half year basis. We ended up over 41,000 crores of cash, highest ever on our balance sheet, and also $6.3 billion in dollar terms. I think the other part is this is also a quarter where we took several steps towards execution of our capital allocation policy. As you know, we announced the buyback, the board approved the buyback in August. Subsequently, it went to the shareholders for their approval. They also approved the buyback. Now, we made the public announcement on October 10th, and now it is, we have filed the draft letter of offer with the regulators. More than anything else, on the employee front, all the operational efficiency improvements which gave the benefit, we also funneled many of that towards compensation increases to employees. As you know, we had one first phase of compensation increases to employees in effective July. Now we have rolled out to the balance employees, and also we had variable pay increase during this particular quarter. I think overall on multiple fronts, we have done, this particular quarter has been stable on, and also the performance has been very satisfying. Thank you.
Hi gentlemen, Kritika Saxena from CNBC TV 18. To simplify this, I will ask the first round of questions to Praveen and Ranga, and in the second round, we can ask Mohit, Rajesh and Ravi as well. So Praveen, my first question to you, as you said, the second half of the year is a seasonally weak quarter, which is why you have reduced the guidance. Can you take us through what the headwinds are? BFSI, retail were expected to be slower than expected. We haven't seen a turnaround in North America in the banking financial services. By when can that improve? And if you can give some clarity on the new strategy of the company, because from what I see, you're reasserting the digital strategy. How will this really be different? Are you going to go aggressive on acquisitions? Can you give us some more details there? And for Ranga, you've reiterated the margin guidance. Can you give us a breakup of the impact this time around? Because you've already absorbed the entire wage hike. There's been the absence of visa costs as well. So if you can give us the exact breakup.
See, from a sector perspective, barring retail, I think we have seen good progress, good performance across the board in Q2. So heading into Q3, obviously, the two primary headwinds are lower number of working days and furlough impact. And it's very difficult to predict where it will land, particularly from a furlough impact perspective. So that is a typical seasonal software softness we expect in Q3. And this impacts all the vertical. Apart from that, we do see some account-specific softness where, because this is the end of the year and there are some budget issues and so on, there are a few account-specific softness. But barring that, we don't see anything unusual. Overall, confidence from a client perspective remains strong. So we expect some of the spend to start picking up from Q4 onwards. So that's why we remain very confident about the future. But I mean, given this typical softness we see and our own performance, relatively weak performance in Q4 historically, we have taken this view on the guidance perspective. From a strategy perspective, I think the strategy that we embarked on ourselves about 3 years back continues to be relevant. This is about our services enabled by software. And whenever, I mean, when we look at what's happening in the market, on one hand, we are seeing commoditization of the traditional services. At the same time, we are seeing a lot of repurpose of spend in newer areas. These newer areas will include your digital, analytics, virtual reality, augmented reality, Internet of Things, cyber security, and so on. So there is tremendous amount of potential in this space. And when we looked at our strategy, what we have been doing in the last 2 to 3 years, we found that we have got the foundational elements in place, but we saw some opportunities where we can sharpen the execution. So for instance, when we looked at the software part of our business, we felt that we need to look at each software in its entirety and have a different strategy for on its own. Because for Finacle, what works for Finacle, what we need to do to turn around Finacle is different from what we need to do from a NIA perspective and so on. Similarly, on the services side, we have seen very, very encouraging results on the new services side. So it's only boils down to execution. So we feel confident that if we are able to focus on execution and have a razor focus, have good governance in place, we believe that we can see accelerating of our growth in the Q4 and beyond. So that's the thing. But broad level, the strategy remains the same. Our investment in ecosystems remain our investments. I mean, we'll continue to look for inorganic opportunities. We'll continue to aggressively reskill our people. We'll continue to focus on large deals. So all those things are there. Many things we have to do the basics, right? But I think there is an opportunity and potential for us to improve our execution and have much more focus, and that's what was our learning from the strategy refresh sessions.
On the operating margins, I think as we know, in the beginning of the year, we said it will be in the band of 23 to 25. We continue to reiterate that. If you look at first quarter, it was 24.1, second quarter 24.2, and the half year at 24.1. We're comfortable in this range. I think if you look at this quarter, coming back to your question, this was the improvement in operating margin was primarily driven by very healthy operational efficiency parameters. Thanks to Ravi's organization, which led in highest ever utilization, on-site mix, subcon, per capita revenue, whichever dimension you look at, all of really improved this quarter. If I were to break it up, utilization gave about 30 basis points, and on-site mix gave about 20 basis point improvement. Then pricing gave another 30. So all put together was 80 basis points. And as a philosophy, we said, look, any improvement because of operational efficiency, we would like to direct back to our employees. So the compensation and higher variable pay accounted for another 80. So essentially it was cancelling out. Then additional 10 came from other cost optimization measures, etc. So overall net increase in 10 basis points. We are comfortable in this range of 23 to 25. So I think that's why we have reiterated 23 to 25.
Thanks, Chandra here from ET Now. Praveen, I just want to start by asking you and Ranga, I think you had a call with analysts during the quarter where you said that initially while people were wary about Vishal Sikka's exit, it hasn't really impacted business per se. So despite that, the guidance cut is sharper than what people were expecting, discounting weakness in Q3, Q4. I was also looking at the segment-wise contribution. It hasn't sharply decelerated, be it geographies or verticals. So, what's the reason behind this? And secondly, as far as the strategy refresh is concerned, can you tell me what happens to specific initiatives like, say, Zero Bench that Ravi was, championing, or the design thinking training, or even, the 2020 milestones that you were working with before? What happens to that? And Ranga, one question that really came in this quarter, I think, was also, currency movements, pound appreciated big time. So going forward, you have said efficiencies for the last 5 quarters, but how many more levers do you really have at your disposal to keep the margins going up even as growth doesn't support you?
See, on the guidance perspective, we have purely looked at our H1 performance and what is the visibility we have in H2. And we also kept in mind the typical softness we see in quarter 3 and quarter 4. And you have to recognize that, while our performance has been moderate this quarter, but when compared with a couple of peers who have announced their results, we are ahead from a performance perspective, from a growth perspective. But if you look at it historically, quarter 2 would have typically been significantly higher, but in this year we are seeing a lot more slowness from a quarter 2 perspective as compared with the historical trends. So given what we have seen in H1 and given what our visibility in H2, we feel comfortable with 5.5 to 6.5. So that is really the basis. And from a strategy refresh perspective, when we look at zero distance or zero bench, we'll continue those initiatives. Now they have become integral to who we are. So those initiatives, every quarter we do have multiple sessions where we cover about more than 15,000-20,000 people over webcast. We get different ideas. We have seen very, very encouraging feedback from our clients as well. Our focus now is on how to effectively monetize some of the ideas. We started that last couple of quarters back, and we want to accelerate that. Likewise, Zero Bench is a fantastic opportunity for us to reskill and retain people, very effective use of people while they are bench. So we'll continue to do that. They are now becoming integral to who we are and the way we operate. Similarly, design thinking is also integral to how we approach the market. So many of our consulting on design-led thing starts with design thinking kind of thing. So that is once again one of the levers that we have for our sales force to use in terms of adding more value to client and so on. So many of the initiatives that we have done, we don't see any reason to jettison anything. Most of the initiatives are relevant and continue to be relevant, and it's now integral to what we do as from an operations perspective. It is just that we feel that we have to now sharpen our focus, because the potential is huge. If you are able to sharpen the focus and have much more stronger governance, our benefits that we can realize can be accelerated.
In terms of the 2020 milestones, anything new that,
No,
a
no.
new number or a new year?
No, we are not. I mean, we are not got to that stage where we are not looking at any numbers. And we mentioned it earlier as well, that 2020 is no longer aspirational.
So Chandra, coming to your questions on the margins, yes, you're right. I think last 8-9 quarters we have been optimizing the levers, and we have seen the results of those optimization. I think management has relentlessly worked on those levers. Earlier the improvement in utilization is self-evident. Now, as you see, this quarter another change happened was on the on-site mix. It came down, it moderated this quarter, that helped us. I think we need to, likewise, the on-site role ratios, on-site cost optimizations, etc., are also the area of focus. I think finally all this also has to translate into cash flow generation. If you look at the free cash flow for the half year over half year has a robust growth of 19%, and that's why we also increased the interim dividend from 11 rupees to 13 rupees in line with that. So that's another outcome. Most importantly, I think while we focus on the operating margin in that range 23 to 25, we have not diluted any of our investments, whether it is in the new areas, whether it is towards employees, whether it is towards R&D, that new services that Praveen talked about, whether it is variable pay, all the future investments that are required to future proof us, we have not diluted. While maintaining that, at the same time focusing on these efficiencies, we have been able to hold on the margins. And this quarter too, all the savings that we got from the 3 factors that I talked about, 30 basis points on utilizations, 30 basis points on pricing, and 20 on the on-site mix, total 80 basis points. Everything was flowed back to employees on compensation increases and variable pay. So I think this range we are comfortable, 23 to 25, we will continue to relentlessly focus. But as you said, yes, revenue trajectory is one of the elements which will always has an effect on the operating margins. So this band we are comfortable.
What's your cushion for the ideal on-site ratio? Is there still some headroom for?
See, I think on-site mix is really a combination of the services, right? Certain services have for example, consulting typically has a tendency to have a higher on-site mix as compared to, let's say, testing. And similarly, new services have a different mix. But I think it's not about having a goal on, force fitting a goal. At the same time, we are looking at service line by service line without diluting growth, without dilating our opportunities. We are looking at moderating that. It had touched 30.2 last quarter. If you look at recent quarters, about 3 years ago, 4 years ago, we are comfortable with around 27. But we need to look at the revenue mix. So we are focusing on it, and also on the role mix and the on-site optimization.
Good evening, gentlemen. Sajid here from Bloomberg Quint. Mr. Rao, I just want to get an idea of this, guidance which you spoken about, low of 5.5 to 6.5%. In a quarter where you did a TCV of $731 million, which is much higher than what Street was expecting. They were expecting around $650 million. You go ahead and you reduce your guidance by 200 basis points on the top end and 100 basis points on the lower end. Where is this pressure coming from on the company? Are there any companies who are going on a slow path with respect to work, or any sector which is putting additional pressure, because of which you have your visibility is much lower there? And the second one is the GST network. You've been working on it. Have you started recognizing revenues from there? That's one question. For Ranga, you had this favorable currency tailwind which was there in the quarter against Euro, GBP and Australian dollar, and that helped you a bit in this quarter. How much of that comfort is there going forward in Q3 as you look at it, and what is the kind of hedges that you have? And even though you have given a guidance of 23 to 25%, is maintaining 24% plus achievable in the next second two quarters?
See, on the guidance front, once again, I reiterate, it's purely based on the visibility we have and also taking into account the historical softness we see this quarter. So typically we have furlough impact and we have the less working day impact in quarter 3, and for us at least historically quarter 4 has been relatively weaker. So it's on that basis, looking at the pipeline, and this one we have arrived at the guidance. So there is nothing barring retail, we have seen, as you have seen in quarter 2, we have seen decent performance across the board, and we expect that to continue. And we expect, I think overall the mood is optimistic. It's just that there may be some delay in the spend picking up, and we remain very confident about the future. And on the GSTN, it's like now it's like any other project. Last few quarters only we started recognizing GSTN revenue. So it's based on the revenue recognition principle, every quarter we look at it. So there's nothing unusual about the GSTN project.
Also, coming back to your point on the currency, if you look at our hedging policy has been very effective in us navigating through very volatile currency markets we saw in the Brexit, for example, the US election, and that has held us in good stead. We continue to have close to $1.5 billion of hedges on a rolling 2-quarter basis. We take a combination of balance sheet hedges as well as revenue hedges. I think this quarter also, I think our effective hedging policy was helpful. More than anything else, this quarter's the margin performance has been driven by the operational efficiency, which we have been kind of tracking and providing trajectory over the last 8 quarters. I think operating margin is always an outcome of revenue growth trajectory as well as the operational efficiency trajectory. We gave a 23 to 25. When we gave in the beginning of the year, we also said we had to make certain US talent investments. So it took into account all those factors when we provided the guidance. Yes, in the first half, we have done 24 is the 24.1. I think at the same time, we are comfortable with the range that we have provided. While we will continue to focus on the efficiency, at the same time, we will continue to invest back into the business. We are comfortable in the range we have provided.
A quick question to Mohit as far as banking and financial services in North America is concerned. Mohit, there's been a lot of concern, and a couple of your peers have also indicated that BFS has seen contraction, is not likely to see, or at least many companies have said that there's no clarity expected before Q4. By when are you expecting a turnaround? Is Q4 a realistic target? And a quick question to Rajesh as far as the energy vertical is concerned. There are some areas where you are seeing a turnaround in energy and utilities, but how sustainable is that recovery based on the conversations you've had so far? And Ravi, if I could understand a bit more on pricing. Last time I remember Ranga was pointing out that pricing last time had seen an increase. So how has the pricing trajectory played out? Is there any change as far as your pricing strategy is concerned?
So let me start. From a financial services perspective, I think we had a very good quarter, right?
Yeah.
If you look at our growth numbers, we grew on a constant currency basis at 3%. If you exclude Finacle, if you include Finacle, the growth is slightly lower. Within financial services, I think our insurance practice has done exceptionally well. And as we review our business, right, I think across all the parameters, whether it's organic growth, if you look at new client acquisitions, we added 13 new logos this quarter. If you look at progress or traction in our automation and AI suite, I think we've done very well there. If you look at large deals, right, I think the one thing that we're very proud of this quarter is that of the 13 new accounts we opened, one of them is in the capital market space, where we opened the account through a $50 million plus deal, right? So the performance has been good, for this quarter and for the previous few quarters. I think the work that we're doing with our clients is very interesting, right? In working with, along with Ravi and, with Rajesh, in the AI and machine learning space, for instance, we're doing cutting edge work in everything from, having clients use chatbots to looking at setting credit card limits to working on fraud use cases. So the work is pivoting away, as is visible in our overall numbers as well. The work in financial services also is pivoting more to our new services, where there is spend, right? Clients are spending money there. So that's the one point that I'll make to you in terms of future spend. The second point is a lot of the work that we are doing with our clients now, right, is learning led. It is not just that Infosys and our peer group needs to refactor or to retrain our talent. It's also our clients, right? Our clients also are looking for an overall capability uplift of their own teams, and that is work where we're getting very deeply engaged. For one of our clients, we actually trained 6,000 of their employees across the world in DevOps, right? For a second client in the US, we trained 500 of their employees on on Hadoop and big data techniques. So my sense is that obviously there will be, there is, as Praveen referenced to the fact that even in financial services, Q3 and Q4 are seasonally weak quarters, and you will have end of the year cost squeezes in some clients. We see furloughs in financial services as well. So I can't give you an exact commentary distinct from the rest of the company. Yes, Q3 and Q4 we will see some softness, but overall, right, overall, as is evidenced by our performance in this quarter also, for the entire financial services practice, banking and capital markets and insurance, I think our franchise is very strong. And again, this quarter we have delivered so far, ahead of our peers.
So BFS in North America is on the path to recover.
I think overall, right, I think the financial services growth this year is not limited to growth in one geography. It's not like, I mean, we have done very well in Europe and we have done very well in Australia, but we've also done well across the board. I don't think there is any specific North America weakness.
From an energy utilities perspective, we've had a very strong quarter. Overall, yeah, so on pricing, what I'll do is I'll give a qualitative cut on it, and we'll ask Ranga to support it quantitatively. It's a maze. Pricing is a maze. It's a complex confluence of a bunch of factors, depending on the service lines, depending on the geography, and depending on the industry you're working on. As you have seen, our new services has outgrown, significantly outgrown the traditional business, and that's a leading indicator of where pricing would be, because new services are actually priced much higher than the traditional services. So the more we can outpace it, the better is the pricing on those services. The second important part which plays is how much we can outpace pricing vis-a-vis automation of traditional services. If we can actually outpace automation in a big way, what that essentially means is you can actually share the benefits with the client and therefore increase pricing. So on the traditional piece, we focused on automation so that we could get an uptick on pricing. And on new services, we're trying to see whether we could continue to increase the pace at which we can adapt new services. Till date, digital has been done in a very small way across the world. The impact is deep, but the embrace is much smaller. The next few years, digital is going to really be scaling, and scaling digital will be the next big thing in the next 3 years. And as long as we stay ahead of the journey, pricing would be to the benefit of providers like Infosys.
Thanks, Ravi. I think on the pricing, I would give two takes. One, if you look at the sequential pricing, it has improved by 1.3%, but a better comparison would be the H1 over H1, which is pretty much stable and flat actually, stable. If you look at last couple of quarters, we used to see in constant currency terms year on year about 1 to 1.5% decline, but it has been stable, the pricing environment. Second part, if you look at one of the most key aspects of this half year has been, while the revenue grew by 5.7%, the headcount reduced by 0.7%. So, I think that is the key thing, because if you look at this half year, we added close to 8,000 less employees net basis to the company as compared to the same period last year. So, the revenues grew 5.7, whereas I think that also improved our per capita revenue to over $52,000 per employee. I think the productivity improvements have also been very healthy this quarter.
Hi everyone, this is Rahul Daima from ET Now. Ravi and Rajesh, both of you, one each quick question. Ravi, in terms of the revenues from the North American market, there's been a steady decline over the last 4 quarters. While you have elaborated a bit more specifics because your peers are indicating some vertical specific issues, but apart from them, are you seeing some client specific issues as well? And Rajesh, in terms of Europe, we've seen some sort of a rebound. So what's really adding to this in terms of, is BFSI really driving that? Because your peers have also indicated that that's really where the growth is coming from. Thank you.
Just to step in on that America part, I think it used to be 65. And one part of it is also that we have been very proactively looking at, broadening that. If you look at some of our competitors, America constitutes only 50%, ours has been 65. Second, there is also currency thing we also need to look at on a constant currency basis. These are the 2 quick takes on that.
And in addition to that, our North America business is not degrowing. It is actually growing. The rest of the business in Europe is outgrowing the North America business. That's the way to look at it. We have had quite a good traction in Europe and rest of the world.
Right. I think Europe has grown we had a strong quarter for Europe. I think it grew 4.5% in constant currency basis. And I think the good news is, of course, BFSI has done well, but we have had other sectors which are doing extremely well as well. Energy has done really well, utilities has done well, telecom has done well, transportation and logistics has done well. And I think the momentum we have is a good one, and I think it will actually continue in the quarters to come. So overall we are, of course there are a lot of talks about Brexit and issues in Germany and slowdown in France and so on, but the reality is that the spending has not dramatically changed, and I do believe that when there will be more clarity on the mechanics of Brexit, we might actually see an even more significant spend, especially from the BFSI segment, as they work towards how do they set up, separate their systems and so on. Some companies have already started thinking about it, but I think there's a big opportunity for us.
Hi, I know we're running out of time, so 2 quick questions on client budgets and spends. Are you seeing some of the clients using in-house and captive centers for spend and not traditionally going out and looking out for IT vendors? And second one on retail, you spoke about some slowdown in retail. Can you elaborate when do we see that pain going off?
Let me take the captives one. So technology is playing such an important role in transforming businesses, right? Everybody, the global 2000 are paranoid about digital transformation agenda, paranoid about newer players coming and disrupting their operating model. So technology is getting revisited, in many ways revisited, whether it is core or non-core by large corporations. And as they do so, they will revisit what part of their skills and talent should be insourced and should be outsourced. So that as the process continues to evolve, Infosys is strategically partnering with them to help develop that agenda, help develop their talent strategy, and therefore be a part of that process rather than actually being defensive about it. And I think that's helping us. So our ability to actually evolve that model and work with the clients to create a insourced and an outsourced mix and help them in the in-source mix. In fact, Mohit spoke about how we are training some of the retained organization of some of our clients, and that might look like we are helping them to build the retained organization, but it also helps us to be strategically partnering with them in that process. So certainly that will be revisited. Most clients will revisit it, but I think we have a role to play to influence and evolve that process as they go through that journey.
And we look, with captives, we have coexisted with captives for many years, right? It's not a new thing. Many of our clients have had captives well before, we had a business with them, right? So,
my point was from the spend point.
From a spend perspective, I think the thing is, from a captive perspective, right? I think in one sense, it's also a recognition of the fact that clients are moving mission critical work to India, they're moving a lot of innovation related work to India. And if the tech spend overall is going up, right, I feel we have the opportunity to capture a larger piece of the pie. So I don't feel it's an existential risk to us. As Ravi mentioned, we're working with them to make sure that we can help them set up the captive, to help them train their people, and to coexist and co-innovate with them, right?
And lend a part of our value chain, right? We're very keen to take a part of our value chain and help them in that process. If the overall spend goes up, we still have a chance to be strategically partnering, actually creating a win-win value proposition for us.
I think
we're
We'll
have to end.
So we'll probably take it up in the main
Thank you, gentlemen.
Thank you very much.